Now, some homework assignments are so simple that there's not going to be any videos for them. However, this problem, exercise 1-19, more accounting vocabulary, is super important. So I want to make sure that we discuss this. So what we're supposed to do is we have some accounting terms, and then here's the definitions. So we're supposed to explain what these terms mean. So now this first one is super critical, the accounting equation. Everything in accounting is based on the accounting equation, so you need to know this inside and out. So the accounting equation is assets equals liabilities plus owner's equity. So remember, assets are things that the company owns, such as the building, cars, office supplies, equipment, land, etc. Liabilities are their debts, things that they owe. And common examples are accounts payable, bank loans, notes payable, anything with the word payable in it, and salaries payable, etc. And equity is just the excess of what's left over from your assets after you take your assets and you subtract liabilities. That gives equity. So another way to look at the accounting equation is on the left side of the equation, which is assets. This is a list of things that the company owns. On the right side is two lists, and it's a list of who owns those assets. For example, if you have a mortgage on your house and you have a $100,000 mortgage, in other words, a loan on the house, then the bank owns $100,000 of that house. So, for example, in a business, if the business owns a building, the full cost of the building would be listed under assets. And then if there's a $100,000 loan left on that building, then that $100,000 is listed as a debt because the bank owns that part of the building. And then equity is the amount of the assets that the owner owns. For example, let's say the company owns a building and it's a $500,000 building. So over here, we would list $500,000. And if the company owns the building completely, then that means there's no debt. So that $500,000 would be listed under equity. All right. Number 2, asset. So asset is an economic resource that is expected to be of benefit in the future. So another way to explain an asset, it's something that the business owns or partially owns. I mean, you could partially own the building, but the building is still an asset of the company. And it has a future benefit. The building will be used in the future, therefore it has a future benefit. Now, an example of something that sometimes students think is an asset but is not is like, let's say you get an electricity bill, and let's say you pay the electricity bill. How would we record that payment for the electricity bill? Well, does that give the company a benefit in the future? No, that gave the company a benefit in the past. So the electricity bill is not an asset. We'll find out later that that would be considered an expense. Now let's talk about the balance sheet. Another critical vocabulary item. A balance sheet is a report that shows assets, liabilities, and equity. So basically, the balance sheet has the same formula as the accounting equation. So it is a report, or it reports on an entity's assets, liabilities, and owner's equity as of a specific date, not a period of time, but as a specific date, like the end of the quarter, end of the month, end of the year. Expense. An expense is one of the things that decreases equity and occurs in the course of selling goods or services. So basically, it's the cost of running your business. So remember that electricity bill? Well, that's part of the cost of running your business, so that's an expense. And also, expenses decrease equity. That's really critical that you write that down and you understand that. Remember from the video, there are 4 things that affect equity. owner contributions and revenue increases equity, and the two things that decrease equity are owner withdrawals and expenses. So expenses is when the company is it's the cost of doing business basically, and it's anytime they pay money for running the business or they promise to pay later. For example, they could put something on the company credit card, which means they're not paying for it yet, but they are promising to pay later. And that expense is for running the cost of business. The difference between an expense and an owner withdrawal is an owner withdrawal is the owner is taking that money out of the business and using it for personal use. An expense is for business use. An owner withdrawal is for the owner's personal use. So like, let's say the owner takes $100 out of the business to buy groceries for herself. Well, that's an owner withdrawal. Let's say the owner takes $100 out of the business and spends it on an office party. Well, that's part of a business expense. So that's the difference between an expense and an owner withdrawal. Now let's talk about the income statement. Another very critical vocabulary term. An income statement is a report that shows the company's revenues and expenses and net income or net loss for the period. So basically, it's showing if the company had a profit or a loss. Now, in the real world, the income statement is often called a profit and loss report, short for, or which is the acronym for it is P&L. So if you hear the term P&L, stands for profit and loss, which is the same name of the report that shows revenues minus expenses. And then it shows either net income or net loss. And net income is also known as a profit. And net loss is also known as just a loss. So remember that income statement shows a profit or loss, and the income statement is also known as a P&L or profit and loss. Now let's talk about liabilities. Liabilities are debts that are owed to creditors. Now remember, creditor is just someone who has loaned money to the business, like the bank. So that's a very critical term. Why is it critical? Because it's part of the accounting equation. Now let's talk about net income. What's the formula for net income? It's revenue minus expenses. So you could say it's the excess of total revenues over total expenses. Revenues, remember, are things, or a revenue occurs when we sell something. Now let's talk about a net loss. Net loss is just the opposite. A net loss is excess of total expenses over total revenues. So in other words, if expenses are bigger than our revenues, remember revenues are sales, then we have a net loss, also known as a loss. And now let's talk about revenue, another really important vocabulary item. We're going to be using it forever in all of our chapters and all of our accounting classes. Revenue, well, one thing it does is it increases equity, and it occurs when we sell a good, like a product. So if we sell a cell phone, that generates revenue. Or if we sell a service, let's say we're doing a tax return for someone, or we're mowing someone's lawn, or we're babysitting someone's kid. That's a service. So a revenue, you can think of a revenue as or you record revenue whenever we sell something. And the other key thing to remember about revenue is it increases equity. So remember, equity is the part of the assets that the owner owns. So how do we increase our equity? The main way that companies increase their equity is they sell items or services. So that's called a revenue. The other way that they can increase equity is just by doing an owner contribution, which is basically putting money into the business to help run the business. I oftentimes will call the owner contributions an owner investment or an investment. 2 more to go. Statement of cash flows. Now, we don't get into detail about creating a statement of cash flows until a future class, but we do want to know what it is at a basic level. So a statement of cash flows reports on a business's cash receipts. So cash receipts means how are we receiving money? Like, are we receiving money by the owner contributing to the company? Are we receiving money from selling things, which would be revenue? Are we receiving money from taking out loans? Okay. And it also reports on, well, how are we paying our cash? What are we using our cash for? Are we using our cash to pay employees? Are we using cash to expand the company by building buildings, or maybe buying a building, or buying land, or buying vehicles and equipment? Okay, so statement of cash flow simply shows how is the company receiving its cash and how is it using its cash. And then the last one we have the statement of owner's equity. This reports on the owner's capital balance and how it changed from the beginning of the period, which is usually a year, to the end of the period. So remember, the 4 things that affect equity are owner contributions, when the owner puts money into the business, revenue, which is when they sell something. These 2 increase equity. And then the way that equity decreases is the owner takes money out to spend on him or herself for personal use. That's an owner withdrawal. Or they take money out or promise to pay for it later for running the business, such as your telephone bill, your gas bill, your insurance, etc. So once again, these are all super critical terms that we will be using throughout all the chapters in this class and in future classes. So remember, accounting builds on itself. So if you do not understand what the accounting equation is now, then you're not going to be able to do chapter 2 or chapter 3, etc. Now, the formula for accounting equation is pretty simple. The math is easy. It's just the classifying of things that sometimes trips people up. So make sure you take good notes and practice studying this.